Hi, everyone. We are here for our webinar series, and today we have a very esteemed panel, and the topic is that fundraising harder than ever for emerging managers. And before we dive into our webinar, I would like to do some housekeeping items. That our firm, Akram Associates, is registered with NASPA, and we will be issuing the CPE certificates if you listen this webinar for at least 50 minutes and answer 3 out of 4 polling questions. We will submit the CPE certificates to you within the next few days. If you don't receive, please shoot us an email. I will be happy to ask my team to submit you. Okay, let's get started. Steve, please make an intro.
Hi, I'm Steve Kahn. I'm the head of operations at Talpion. We are a single-family office. We very much, in some ways, look and feel like a hedge fund ourselves in that we manage about 70% of our assets in-house in the public markets. We allocate to hedge funds about 20% of our assets, and we also do some private equity and direct investments. My role is, more on the operations, accounting, risk, IT, compliance, light legal, and HR, plus whatever concierge services are needed to be provided. I just want to say for the attendees, all of my comments are off the record in case anybody from the media is on with us, and any opinions that I express are strictly my own. And no animals were harmed in the making of this production, but that's neither here nor there.
Okay. Lance, would you like to go ahead?
Sure. My name is Lance Baracker. Spent 15 years as a derivative trader on the floor of the Amex. I'm managing director and partner with Bob Marietta at Cap Intro Solutions. We are an outsourced Cap Intro platform, and excited to be here today.
Yes. And clearly, I am Bob Marietta. I'm a managing director at Cap Intro Solutions. I've been here about 6 years now. We are an affiliate of Stonegate Global Fund Services, who owns Cap Intro Solutions. We are, as Lance had said, we're an outsourced capital introduction team, very experienced. We offer products in the institutional and the more retail space. And hopefully in the beginning of 2025, we'll be looking to add some third-party marketing or placement agency businesses as well.
Awesome, thank you. Let me make a little bit intro about our firm. I'm a founder of Akram Assurance Advisory and Tax firm. We provide audit and tax services to hedge funds, private equity, venture capital, family offices, and real estates. Our headquarters is in North Carolina, and we have offices across the globe and in the US. Okay, so in today's dynamic financial landscape, emerging managers face exceptional fundraising challenges, and some of our clients feel the same way, and mostly clients are emerging managers. And this is very good for them to listen to the webinar and get some insight from Cap Intro and allocators are on the panel, and if they have any follow-up questions, they can reach out to them. But also on the screen, there are ways you can ask us questions under the questions section or under the chat. Please feel free to ask. Our panelists will be happy to answer any of the questions you have. So Steve, before we do and define emerging managers, what do you see overall the landscape for emerging managers to raise capital?
I think that for emerging managers as well as those that are established, in speaking with my peers and a bunch of funds that we're in touch with, it is an insanely difficult landscape, and it's probably been so, I would say, for at least the last 9 to 12 months. Very, very challenging, more now so than ever. The reality is that, as an investor, right, we look at, the landscape, and, the reality is there's a lot of concerns. There's a lot of, geopolitics. interest rates, inflation, the economy, the election, what the markets are doing. It's hard to get excited to make an allocation when the markets are at an all-time high, right? Just as an aside. And quite frankly, what's really been working against all managers is that, unlike 4 years ago, where really my peers and I, there was a constant search for yield and return. Over the last bunch of months, prior to the Fed cut of 50 bips, earning anywhere from 5.2 to 5.38% in a 3-month Treasury bill is not a bad place to park our money. So there has been no impetus really for us, given all the factors I just previously noted, to deploy capital as quickly as we've previously done in the past. And that, unfortunately, is just what I see as the current reality out there.
Thank you, Steve. Bob and Lance, what do you think? The same way, a little bit different than Steve, the landscape for these emerging managers to raise capital?
Yeah, and I would agree. Definitely, interest rates have played a big role in what we've seen from engagement levels, and it's interesting. I would say probably in early 2023, we were seeing some engagement, and then as rates continued to climb, a lot of those conversations just dried up. And as Steve said, I think investors got very comfortable saying, okay, I can get, I can buy a T-bill and get a comfortable return, and risk, not risk-free, worry-free, but as close as you probably can get to it. And I will say, at least now we've seen, the rate cut the other day, and I think that was anticipated that it may come sooner. And, I would say beginning of this year, we were having a lot of conversations, and we still are. And I think a lot of it was due to the anticipation that there was going to be a rate cut. It didn't happen until 2 days ago, right? So we're encouraged, though, that now we think this is really going to spur a lot more conversations.
Lance, anything you would like to add?
No, I agree with Steve and Bob, especially with, where we are in the marketplace at the highs in the S&P and NASDAQ. It becomes difficult, at least what we're hearing exactly from Steve, for investors to, make allocations. They're looking for strategies that might be more on the hedge side, low net we're seeing, and also strategies that are, negative beta, obviously to the market right now. So whether that's PE, whether that's real estate, whether that's crypto, other strategies not focused, on the equity markets.
Awesome. So let's define what the emerging manager, what's the definition, different allocators, institutional investor participants define the emerging managers differently. I don't think there's a very hard and fast rule, but let's ask Steve. Steve, who do you consider emerging manager, and whether there's a difference between established and emerging managers? How would you categorize these?
I mean, listen, from our perspective, and I know that a lot of different investors categorize them differently. For example, I know the New York Common Fund considers an emerging manager anyone that's under $1 billion, right? Regardless for the number of years that they've been there. We don't actually follow the same approach. From my perspective, an emerging manager is someone who is finally taking their fund for however long it's been in business to the market to try to raise capital. And the reality is, from that point, you really have maybe 15 to 18 months to be the new thing, right? And try to get traction, try to get your name out there, try to get people to follow you and look at you. Typically, for us, emerging managers are ones that are newly forming. We happen to like emerging managers simply because for us, the empirical data suggests that investing in a newer launch, years 1 and 2, the performance tends to be greater than years 3, 4, and 5. We love founders class, which typically is what you see in emerging managers. And because emerging managers are emerging and generally do have lower AUM, we're able to participate and take a consultative approach to working with them in terms of best practices, because it just aligns our interests with theirs a little bit more closely. And, look, we invest in managers for two reasons. One, either we don't have the edge or expertise in-house to make an allocation to a certain sector. A great example would be healthcare, right? We could probably have gone out and hired a healthcare analyst with an MD or PhD after their name that knows stuff like biology and chemistry and drugs and stuff like that. Instead of doing that, we found two excellent healthcare funds and decided to make allocations to each to give us the same exposure without the add to headcount. But, it's a great opportunity for emerging managers because we love to see them grow. We love to see them succeed. And what we have also found is that sometimes emerging managers, when the assets tend to be somewhat smaller based on their particular strategy, their position sizing and conviction tend to be more in line than when they get much larger, and there tends to be skew, which ultimately, sort of dampens the returns.
Yeah, and I would agree too, Steve, to say like every person's going to have their own definition or what is considered to be an emerging manager. Like for example, we're talking with a manager who has managed his own funds for 18 years. So if you're looking at length of time, is he emerging? No, he's been in the market for 18 years. But as you said, now he's opening up his fund to look for external capital. So is he emerging in that sense? Yes, he would qualify, right? So it's hard to, as Mohammed said, there's no hard and fast rules to say, okay, there's a timeline or there's an AUM amount. I mean, I think the one thing that we do see is, and we do have investors that are particularly interested in emerging managers. The perception is, especially if a guy is just coming out and just launching for the first time, yes, he's an emerging manager. And the perception is there's a runway there, right? And there should be a lot of upside, hopefully, right? And so we do have some investors specifically looking for emerging managers, in that space. The hurdles that we kind of see really is, there's two real big hurdles. The first hurdle in AUM size is really 10 million gets you out of that retail high net worth space, maybe into, some of the smaller family offices. And of course, and the next big hurdle is that $100 million barrier, which opens you up for the larger institutions. So that's kind of what we see and how guys progress. But emerging really is, what you personally feel about it. I don't think there's a right like timeline or an AUM number that you can have in mind. I don't know how you feel, Lance. Go right ahead.
Listen, I agree. I think what Steve said, we see a tremendous amount of managers just starting out with family and friends capital, just trying to build a track record, right? And so they do that for 12 months, try to get track record underneath their belt, and then they go out to the investors and they try to raise capital. So in my mind, that's emerging, from that. Because that's a key that they're trying to get outside capital outside of their circle. We see that as as well, and it comes down to experience as well, right? Maybe they've been in the space, but they weren't in a role of running a fund, and so they might have been in a bigger shop, whether they're an analyst. And really starting a new fund. So that's emerging in my mind as well. But I agree with Steve. If you really take a look, and Bob, all the white papers out there, especially from an investor standpoint, the first 2 years, 3 years in a manager's cycle is usually his best performing, and that's really you want to get in and try to find some of these undiscovered managers.
Exactly.
I would like to add here a little bit about, as Lance mentioned, about when you're launching your first fund and you may not have a lot of track record, and sometimes fund managers like to incubate the fund with their own money before they raise capital. In that scenario, they can hire an auditing firm to audit their track record, so it's easy for them to raise capital rather than wait for a year and audit financials before they go into the market. Very good point. Thank you all. three of you. Let's jump on the landscape. We have already touched here what the landscape is, but is there anything specific, Steve or Bob or Lance, you want to mention here? We did not touch. That's
Yeah, why don't you guys kick that off, Bob or Lance?
Okay, well, with the increased competition, I'm going to just go right under that first headline there, growing number of fund managers. And absolutely, Lance and I see it. We talk to no shortage of managers out there, right? And let's be honest, why wouldn't we, right? I mean, it's a pretty, ridiculous question for us to ask a manager, are you raising capital? Who's really not, right? I mean, some aren't, I get it. Some are at capacity, but for the most part, every alternative asset manager we speak to is interested in raising capital. And there are a lot of funds out there. What we've really seen, particularly since the pandemic, you got a lot of, like we said, emerging, early stage startup managers that, where the AUMs are going to be a little bit lighter, right? They're going to be, we see a lot more managers nowadays starting, sub 10 million, sub 5 million. Strategies obviously have changed over the years dramatically. And now we see a lot of digital type funds out there with some really outsized returns. But it's changed the landscape over the last 4 to 5 years. And I do think, especially since the pandemic, we've had so many people start funds up, and when you see our name, Cap Intro Solutions, just naturally people will do a Google search or go on LinkedIn, and again, Lance and I have no shortage of conversations. So there are many managers out there.
I think that there are a lot of managers, but being able to demonstrate differentiation, I think, is a result of the competition. But I also think that the differentiation in and of itself has become somewhat challenging because, candidly speaking, and we see a lot of different funds, I get a lot of funds introducing themselves to me. At the end of the day, what I can assure you, and Bob and Lance, you guys can tell me if you think this is true or not. At the end of the day, everybody has pretty much access to the same data, the same information, the same access to all of this information. Everybody is using AI, right? That's what I see on every single, one pager, right? We have the biggest databases. We do the deepest fundamental research. We have all of this technological overlays and AI helping us make investment decisions. In that regard, everybody is the same. That is not a differentiator. And what the true differentiator is, and it sort of leads into like the investor preferences, it's performance, right? Because I assure you that take two equal emerging managers of equal size, the one that actually has positive performance in a particular investment strategy and thesis that they employ versus the one that actually has negative performance, the negative performance performer is really not going to get the same traction as someone who could show that they have positive returns. Because at the end of the day, we look to invest in people who are going to make money. That is the, of course, preferred goal, but people sometimes forget that.
Right. Steve, I agree with you. I think performance gets you in the door. Like we always, I always say that, listen, performance is great. It'll get you into the investor door. But at the end of the day, once you're in it and you're having a meeting with someone like Steve, how do you generate alpha? Like that's, what's your process, clear and concise? I think, when it comes down to it, there's a performance, in there, but you have to, clearly define that, when you're talking to investors, what your process is, what makes you different. As Steve mentioned, people might have access to the same data, or at least have the ability to get the same data, but what are you doing with it? And you don't have to give away the secret sauce, but at least define how you're going to generate alpha and how you're different and how, what you're doing with that data.
Yeah, agreed.
Yeah, and that was a great point, though, Steve, that you made about differentiation, right? Because that's what we say all the time. You've got to go out and say, okay, there's another manager just like me. What makes me different? Why would you invest in me above the guy sitting next to me? And, you know, it's funny, we look at a lot of marketing materials all day long, you know, between tear sheets, pitch books, et cetera. And we always say, particularly when you get to like a pitch book, it's like, you know, again, as Lance said, we're not giving away secret sauce, but hey, why am I looking? Why is this investor looking at this, right? And you've got to come out with that like right away. And what we have seen, one of the mistakes I think we have seen is sometimes it gets buried later into the message. You know, for example, you know, we were looking at a deck a few years ago, and before we even looked at it, it was like, okay, why are we looking at this? Why, you know, why you and why are you different? And we were given the reason. And we said, okay, as we went through the pitch book, that wasn't mentioned until page 8. And unfortunately, and Steve, you'll probably know this better than anybody, you're going to lose that person by page 8, right? Sometimes they don't get to page 8. If they get to page 3 and they don't see anything different and it looks like everyone else, they may move on, right? So we always say, make sure you're differentiating yourself. Why am I looking at this fund? What's different about me? So great point.
Right. And we're also, you know, now with the way the world is, there's going to be equally as much scrutiny on the IDD side, the investment due diligence side, as there is on the operational due diligence side, right? Is the investment thesis scalable? Is it repeatable? You know, is there proper controls in place? Time for a polling question.
Thank you, Steve. Let me launch the polling question. Which of the following statements best describes an emerging manager? A fund manager with 10 years of experience. The relatively new fund manager with innovative strategies and less than 3 to 5 years in operation. C, well-established fund manager entering a new market niche. We can give them another 10-15 seconds. In order for you to get a CPE, you need to answer 3 out of 4 polling questions. Okay. Key challenges faced. Lance, let's start with you, right? So obviously there is a limited access, then the SEC regulations are also very painful for the fund managers, and then also macro environment is not great for emerging managers to raise capital. What do you think are the biggest challenge fund managers face overall?
Well, I think the biggest, you know, obviously challenge, you know, that they face is hopefully scaling the fund. But obviously from a regulatory change, as you mentioned, you got a shift in transparency, liquidity, selling. I know, you know, they just, you know, basically shot down, you know, one of the transparency rule with the, you know, with the SEC, where before funds had to disclose, you know, material facts before it was quarterly, then they wanted to do it in one day. So there's a lot of things going on, you know, from that aspect of it. But when we're dealing with emerging managers, you know, I think obviously you got the operational side of the business, and then you got, you know, the capital raising, you know, side of the business as well, right? And then you have, as Bob always says, and I want to take it from him, is there's 2 jobs you have. You have performance, and then you have raising capital. So I think as a 1 or 2 person shop, you know, you need to, you know, outsource. I think outsourcing is, you know, and Steve can Bob comment on this, is, you know, is outsourcing, and, you know, Mohammed, is there's plenty of service providers out there that can help you, you know, with the infrastructure aspect of it, and kind of build that, you know, operational side of it. And then as well as, you know, on the trading side, you know, whether that's OMS systems, EMS systems, risk systems, you don't have to build everything your own and spend millions and millions of dollars, you know, trying to do that. And then there's, obviously from the capital raising side, firms like us and other firms out there to try to help, raise, that side. But I think, Steve, as you mentioned a little bit about, the ODD, maybe you want to talk a little bit about that, on that process, because I know that's a key part, especially from an investor standpoint. And, a lot of managers at least fail, if they can't get through that process, right, Steve?
Yeah, most definitely. And I think that we're actually going to be able to hit on that in a little bit. I think that if we talk about the challenges faced, right, it's really twofold, right? Are you able to manage money? And are you able to do so successfully, right? And then there is, well, how do I get access to the people that could potentially raise money, right? Whether it's directly, like people calling me or emailing me or whatever it might be, or through the CAP intro teams, such as yourselves. And, there's lots of them out there, right? And even when we talk about emerging managers, right, from our perspective, right, an emerging manager can still be institutional-like, because we strongly believe in the concept of being good enough for where they are now. So, Lance, you talked about outsourcing, right? We've invested in funds that didn't have the AUM to bring on a CFO, right, and a CCO initially. And they outsourced it to one of those providers. From our perspective, we get it, right? That makes sense, because if your overhead is too high and your fund, expenditures are going to be outside of the range from when we're having our, ODD conversation, it's not going to be saleable, right? So we understand that, and it is saleable. I mean, the smallest fund that we ever did something with had $4.2 million in AUM, and it really was because my owner was very interested in seeing how they think about things and how they trade, because previously his background was in finding and cultivating talent, in Highbridge, as they were building it up. So we like, he likes listening and hearing different stories and different viewpoints and taking that in. I mean, the regulatory environment, it's just like a nightmare, right? It's a sunk cost. It's kind of horrible, but the nice thing is that it's binary, right? You're either in compliance or you aren't. So, it's just a matter of either, getting and working with a good consulting firm to make sure you have all your bases covered, or if you ultimately bring that in-house and making sure that you've hired the proper talent to be able to do so. It shouldn't be a hurdle. I consider it more of a severe annoyance. And, the reality is, as we were talking about before, the key challenge is attracting capital. And what I wanted to bring up before, which I was remiss in doing so, at the end of the day, any fund needs to be able to demonstrate that they can generate alpha, right? But they can't just say, hey, we generate alpha, because when you come and meet with us, we're going to say, okay, well, how can you demonstrate that you've generated alpha, right? And it really is kind of easy. You take the long side and you take the short side, you separate them out. You look at the gross return over the average gross exposure, you compare it to whatever relevant index that you think it is. And we're going to see the numbers as to whether or not you've really generated alpha or not. You know what I mean? So, that is something that is sometimes overlooked, but in a granular conversation, which is exactly the kind of conversation you want to be in, that's where you need to be able to demonstrate your abilities.
Bob, you're on mute.
I'm sorry, I muted myself. There was some noise behind me. I didn't want to interfere. So I would probably, just to back up and expand a little bit on what Lance touched upon is, yeah, absolutely. We talk to so many 1- and 2-person shops, and I say it all the time, and I'm sure Lance is tired of hearing it, but it's very hard to do both, right? To generate returns and raise assets. They're both full-time jobs. So, outsourcing, we think, makes sense in that space. Now, so that's some of the challenges that managers are going to face, like your size. Do you have the infrastructure? Do you have the funding to staff? If not, I think you do need to outsource, and you have to focus on where your strengths lie. So if you generate performance, then that's where you should be, and let someone else do the heavy lifting, like we do in the cap intro space. Or if you're a market, if you're an asset raiser, then maybe you need to hire a trader. I don't know, but if you have the capability to do so. But it's very hard to do both if you are a small shop, like 1 or 2 people. But some of the points that we made here on the pad or the slides here, like some of the challenges that are out there, economic uncertainty. I think some of these are all self-explanatory, right? I mean, we're heading to an election in 6 weeks, 2 pretty divergent paths that we may be going down, and I don't need to touch on that any further. I think everybody knows what we're looking at there, and regulatory Steve is more in tune. He touched on that. But the one point I wanted to make was towards the bottom about limited access of capital. One thing we don't do is our business is, we like to say that our investors are first to be second. So we're more looking at LPs. We don't really, seed capital, anchor investors. That's not our core business. And there's not a lot of them out there. So that is a really, really difficult spot. And it's a conversation we have quite frequently because, as you can imagine, we do talk to a lot of startups, and they're always looking for, a seed capital. And there's just not a lot of opportunities out there. So we try to help where we can, but it's certainly not enough for us to be a core business for us. And, difficulty in the institutional space, as we touched upon earlier, that magic number is 100 million AUM. Until you get in there, it's very difficult. And I'm not going to say that never happens, because we've had instances where we had, sub 100, sub $50 million managers looking at some pretty large allocations. Can it be done through an SMA because somebody doesn't want to come in with a large check and be more than 10% of a smaller fund? Yeah, if you have an SMA capabilities, that could happen. But I'm not going to sit here and tell you that it happens every day, because it doesn't.
Yeah, and just like you said, we'll never be more than 10%. Yeah. And we actually really dislike SMAs because it causes a lot of other issues for us from a tax perspective. So we prefer to be in a commingled vehicle.
So, Steve, my question to you is, I have heard some people don't want to be more than 5%. Is this your personal preference to be 10% of that, not more than 10%?
That is generally we'll never want to be more than a 10% investor. And conversely, we may never invest in a fund where, this is where it gets a little complicated, but a founder, right, is 30% of the fund, right? And as part of his founder's class, let's just say he has a 2-year lock. 30% of the fund has a 2-year lock. We're talking to them now where there's only 6 months left in that lock. So that's a problem for us, right? It's a problem for us because we could come in, but then 30% of the fund could be redeeming in 6 months, which would not be good. I mean, it would be bad. I don't really think that sort of represents its own kind of risk that we would need to assess and evaluate.
Steve, what do you think where fund manager doesn't have any skin in the game in that fund? Do you prefer?
It's not saleable, Mohammed. It's not saleable, right? And it's interesting you should ask, because that happens to be one of my top 5 conversations with an emerging manager. One of the questions that we ask, what percentage of the portfolio manager's liquid net worth is in the fund? Because that represents an alignment of interests. He said, the response was, it's actually only 10 or 15%. Now we expect like 50 to 75. And I said, where does he keep his liquid net worth invested? Because that's where I would like to invest. I mean, seriously.
Very good point. Okay, time for next polling question. Let me drop the question and lost a second. What is one of the key challenges faced by emerging fund managers in the current fundraising landscape? First, abundance of anchor investors. B, increased market volatility and economic uncertainty. C, reduced regulatory scrutiny. We'll give them at least another 75 seconds before we close the poll. Just to remind people, if you want to get the CPE, please answer the questions. We need 3 out of 4 polling questions. Okay, let's move forward. Investor behavior trends. Start with Bob. Do you see some of the trends we have mentioned here? Is there any recent trends you have noticed this year versus the prior years?
Yeah, I mean, they're always going to, we always get, particularly more so in the institutional space, we're going to get more criteria that we need to check those boxes, right? We're going to hear, hey, we want to see a track record of, could be, 12 months, 24 months, 36 months, whatever we want to, we could hear that from investors. Certain performance ranges. Hey, we want to see, 10 to 15%. We want to see 20% or better. So that's more so on the institutional side. And again, we have a couple of different products. We also have more of a retail high net worth product, and we don't hear those type of questions as much as we do from the larger, more institutional types. Many times in the high net worth space, you're going to hear, "Hey, I want to make money." Not that they necessarily don't care. They're not strategy, averse or whatever, but agnostic, I guess is the word I'm looking for. But they are looking at returns and more in the high net worth space. And it's funny, we do talk to some managers and they'll say, "Look at me, I'm great, I'm up 30, 40%," and that's fantastic. But we really are very conscious about how they get there on a month-to-month basis. So that's why you always want to see a tear sheet. We want to see how they handled it, and especially these markets nowadays are so incredibly volatile. We want to see how they're managing the volatility month to month. And many times, I mean, I get it, it all comes out in a wash, but you're up 40%. But if you're getting there by each month being up 20, down 40, up 60, down 30, that's not going to, give an institutional investor a warm and fuzzy feeling, right? So many times that it's not a fit. So we kind of see that from the investor side, and that's, a lot of what we do, and I'm sure Lance would agree, we say it all the time, is a lot of it's education, right? Especially when we're working with early stage emerging managers. Like I've had guys come to me and say, "Look at how great, look at my performance." And I'm like, hang on a second. It does look good, as it comes out in the wash and it looks great. However, the route that you got there is not going to be something that's going to be attractive to a institutional investor where those allocation tickets are much larger. They're going to play it much closer to the vest. A high net worth investor who says, "Hey, I'm going to come in with a $100 or $200, $250,000, yes, they might be looking for that kind of volatility and want to hit a home run. But as you move up the ladder, I think investor sentiment becomes obviously much more conservative because they're going to the check sizes are bigger. But Steve would know better than I about that.
Due diligence.
I don't know if that's 100% true, but look, some strategies are by definition going to be more volatile. Right, some could be wildly volatile, and if there is a sleeve of assets for fulfilling, that particular type of investment, that's fine. But it's not really for the faint of heart. And we've been involved in situations like that, and at the moment that is not something that we're looking at. Although unfortunately, some of the performance that we've seen over the last year. That shouldn't be very volatile has been insanely volatile. And that's just basically been because of the commercial tenure of the manager and the ability to trade in incredibly uncertain markets, which, you know, isn't something that newer and or younger portfolio managers have experienced, right? Because it's been sort of nice, except for, you know, what we saw in 2020. And then, you know, of course, before that was the 2007, 2008. You know, there might be some risk aversion, you know, on the due diligence side. You know, even though we're a family office, you know, we are and probably would be very or considered more of a sophisticated investor when it comes to the ODD. And, you know, for all of you emerging managers, you know, I'm going to tell you a secret, right? You're going to speak to investors and you're going to go through the investment due diligence process. When you get through the investment due diligence process, if, say, here, they like a manager and they say to me, Steve, I want you to go and do an ODD. What that really means is that whoever you spoke to as an investor is interested in investing. And they're going to send the ODD people, right, to speak to you to look for a reason not to invest. And unlike investing, which has asymmetric returns and things like that, on the operational due diligence side, it's relatively binary. You either can demonstrate that you are able to manage the business of managing money and have controls and have oversight, or you don't. Or you decided to use like non-saleable policies and procedures in the way that you conduct your business, or there's just fatal flaws like the portfolio manager and the CFO are married, or the CFO and your auditor are married, right? That's kind of going to be a severe red flag. But truth be told, even if you're emerging, if you think about what it means to get through an ODD, if you have 10 ODD meetings, if you aren't walking away with 8 or 9 new investors, what that really means is that you have a flaw in the way that you're set up. Because, you know, and even if you extrapolate that out, 18 out of 20, right? 45, 46 out of 50. There shouldn't be anything that an investor hears during the ODD that they're going to say, yeah, no, right? Because we all ask the same things. We're all going to go over the life cycle of a trade. We're going to talk about personal trading. We're going to talk about valuations. We're going to talk about, you know, the controls, who your vendors are. We all ask the same stuff. And unless you really have chosen very poorly and made some very bad decisions, there is no reason why getting through the ODD should be a hurdle whatsoever.
Awesome. Thank you, Steve. Let's jump on the strategy. So who would like to dive in here, the strategies for emerging managers, right? So I think we have already discussed most of the things, but anything someone would like to add here?
Well, I think, you know, strategies for emerging managers, you know, in general, when you're trying to find or match up investors, you're not going to be everything to everyone, right? So I think, you know, at least the key for, you know, from a strategy is clearly defining who you are and what that strategy is, and because that's important, right? And if you're a volatile strategy, as Steve and Bob mentioned, okay, that's volatility. Okay, where are you getting that volatility? What's your risk reward? It's setting proper expectations. So when you go into a meeting with Steve or another family office, you're setting the proper expectations, you know, and this is who you are, and try to do a little bit of homework beforehand. And for instance, let's say, you know, I'm only using Steve, he's the investor family office, and he is looking for, you know, equity strategies that have low vol. If you're an equity strategy that has a high vol, there's no point in speaking to Steve right now, right? It's a waste of everyone's time and your time too. So I think, you know, from that standpoint, You want to be, effective. You want to come across and know who you are and try to find the investors that will allocate to you. They have the same type of, looking for the same type of statistics, going into it. Transparency obviously has always been a big play into it, and being transparent and giving access, to the investors. That's whether it's on a daily basis, monthly basis, obviously going through, the outsourcing with your fund admin, with your auditor, using those service providers, try to give, an look to it, and leveraging technology. There's a ton of technology out there that helps that process, that works with investors and managers, on that front. I think you just got to be true to yourself and, in general, and really try to match up or find those investors that look for your strategies.
And truth be told, I mean, if you think about it, anybody that's talking to you, because you guys have heard it, seen it all so many times, right? Especially for emerging managers, you're able to help filter out what they probably shouldn't be doing and help them find, what they, should be doing. A couple of points, you take the tear sheets, because I get lots of tear sheets. And it's so interesting how, unless I read the 6-point, fine print on page 2, wearing a pair of binoculars, so that I see the years that they returned 34 and 43% were hypothetical, right? Without it being very clear up front in the little charts that they provide? No, right? Or if I have to, again, read the notes to see that it's actually gross returns that they posted versus net returns, I'm not interested, right? You have one shot at, like, kind of meeting us, for lack of a better term. And that's not just us. I mean, that's going to be all of my peers. You need to be very clear, and you need to not, say, oh, they won't see this thing buried in the, 800 words of disclaimers and disclosures at the bottom of the tear sheet. It's like god awful, right? And, we talk about, building trust through open communication, right? For some reason, I'm one of the few idiots that actually answer the phone when people call me without even looking at the number or who it might be. So I end up talking to emerging managers, and I'll own that. But when and if you're talking to me, you need to be very forthright and magnanimous about what you say, because, hold on for 1 second. Because I got a call from an emerging manager, and I'm going to ask questions. Right? What's your strategy? How long have you been doing it? What's your AUM? And when I asked the AUM question, the guy said, well, we're sub $10 million. I'm like, okay, so, how large of a fund are you? He's like, well, as I said, we're under $10 million. I'm like, okay, so you have $1 million under management. He's like, I didn't say that. I go, was it 500,000? He's like, I didn't say that. I go, and that's the point. You couldn't answer my question. You couldn't just tell me what your AUM is because you were embarrassed or because you didn't want to tell me. Great speaking to you. Best of luck. Right? It's absurd. Right? It's the perfect way of ruining a very nice introduction.
That's a really great point, honestly, Steve, that you just made. Because again, we come across, I mean, the first thing we do is someone wants to talk to Lance or I, we're saying, okay, before we get on the call, send us your marketing materials. Let's take a look. Or you got a tear sheet, pitch deck. We'll take a look at it. And it's amazing, though. And again, we are not marketing material experts, but we've seen enough of them that we can kind of point you in the right direction or whatever. And one thing I always stress is, put your AUM on it. A lot of people don't want to, and many don't. And I always say, put it on because you're going to get asked anyway, right? So, you're not hiding anything that it's going to come out in the wash. So,
right. Right. Put that little tilde mark. It's like approximate,
And as far as like back testing and whatnot, we always say just don't show back test results. Nobody wants to see them really. So, Steve, you sound like one of those guys when you open up a PDF, you hit Control F and type in like pro forma or something like that, backtest it, and make sure you filter those out, right?
Yeah, I really don't. I like to see, like, I look at, like, fund was established in 2021, and then I go down and I see performance from like 2017, 2018, and I'm like, where the hell did this performance come from?
Yeah.
Right? And it doesn't have like asterisks. It isn't in a different color. It doesn't say hypothetical. It doesn't say, traded by my kid. I mean, you got to really read into it, and it shouldn't be that hard to present your information to us. And, if you try to spin it, all you're doing is really doing yourself a disservice and damaging your credibility, where that's not kind of the way you want to play it on a first introduction basis. You know what I mean? And just
Great.
like you said, like, Bob and Lance, you guys know that we don't invest in real estate funds, right? So how many real estate funds are you going to get all excited about introducing to me, right? Because I don't care how excited you are. I don't even care how excited the portfolio managers. Why? We don't invest in that, right? So I'm not going to have a meeting. I don't want a tear sheet. I don't want a 10 megabyte document that's going to fill up my inbox. We just don't do it, right? So save yourself some effort, save yourself some time, right? You guys know what your investors want. You know what I don't want, because I'm going to tell you up front, and then move along.
Time for a polling question. Thank you. And Steve, this polling question really tells what you just said. Let's see if they hear.
I like giving the answers to these things before the questions come up. But I was always that kid in class who liked to try to get the answers before the tests. Write them on my hand.
The third polling questions, and we will give them another 30 minutes. But in the meantime, I can repeat the question. What strategy is recommended for emerging managers to build trust with investors? A, network strategically, leverage technology, third, enhance transparency. 80% people said transparency, and 14% people said networking, and technology is the third one. Okay, let's close this and jump on the future outlook, and then we have 7 minutes to go, and I believe we can. This is the last sheet. Then we have a last polling question, and then we will issue them the CPs, whoever has answered our 3 out of 4 polling questions. So future outlook. I know there's a lot going on this year. A lot of trends are being happening because of the AI. Election is coming, and interest rates, macro environment, monetary policy, fiscal policy. Right, a lot of factors are in play. But Steve, my question to you is, how do you see the outlook for raising capital for investors?
Listen, I think that with rates coming down, I think it's going to, maybe have investors, rethink, right? Is it time to allocate, or do we, lock it up again? Depending on the strategy, look, short only funds, this is a nice time to be a short only fund, right? It's kind of a more difficult time to be a long only fund, right? Especially with the market where it's at, just, in that way. It's interesting when you want to talk about trends. We were just listening to a global economist at a bank saying, look, everything is well and dandy now. We project U.S. interest rates to be, at around 6% in the next 18 months, which is, quite a difference of where we are now. So, it's kind of doom and gloom, but, it also gives us pause to say, what, cash, could be king over the, coming months. Hard landing, soft landing, no landing, recession. it's just hard to say. But again, we're following managers and we'll continue to do so, and looking to see, how they generate alpha and how they perform in context with, the particular strategy that they follow. And, we like long short managers, and we have a whole bunch with a whole, different spins and twists and types. And, we're going to continue to look at them.
Bob?
Oh, I think, well, I'll start on the bottom and work my way up. I think collaboration with larger firms, strategic partners are going to be key for emerging managers. Lean on those service providers that you're speaking with. As I'm sure Steve, Lance, Muhammad, you'll agree with me. We all know a lot of the same people, right? And we're out at conferences and events, and we know, and a lot of people laugh many times and say, hey, Bob, I'm tired of seeing your face, because when I open LinkedIn, it pops up. And I guess that's a byproduct. I got like over 14,000 contacts, and I'm sure there's many people that have many more than that. But, typically I do tell our clients, hey, we're here to help. We're a partner in the space. And if, you need help somewhere, especially between Lance and myself, we'll probably know somebody that can help you. Or if not, we'll be able to find somebody. I can go on LinkedIn and probably find somebody in a second, right? So, especially if you're starting out and you're emerging 1 or 2 person shop, lean on your providers. They're all experienced in the space with relationships, and get that help there. Everybody's willing to help. So please, take advantage of that. And then the top point, growth in niche investment strategies. Niche is key, right? I mean, we hear it many times on the investor side. It's like, if we're talking to an investor about a manager, they might say, okay, yeah, I got a million guys like that. What else you got? Show me something different. And, so we touched on it earlier too, about differentiation, unique niche strategy. So you got to make sure that you stand out, because that's what people are asking for.
Yeah, for sure.
Okay, so let's go to the polling question and answer last polling question, then we can wrap this up. Which of the following is an emerging trend in the investment strategies? A, decline in niche investment strategies. B, growth in niche investment strategies. C, reduced use of alternative data for decision making. Okay, let's conclude. Obviously, I'm mostly emerging managers attended this event, and I'm just want to ask you, everyone, all of my panelists, what's the main theme they should get from us today if they want to raise capital after the election of next year?
I think truly, what I have seen from the really successful managers who have been able to raise money and continue to raise money is they're very focused on qualifying the potential investors that they're looking for to make sure that they're real and not wasting their time. That when they do ultimately speak to them, they have practiced how to present their investment thesis in such a way that it's going to be understandable to certainly a diverse audience, that emerging managers have done enough to be institutional-like in the way that they manage their business, and that they rely on their partners. You don't need to spend, and you won't be able to raise money if your expenses are too high. If your expenses are too high, but you can still lever all the technology that your service providers, are offering, and be institutional-like. So as I said, I assure you, the $4.2 million, fund that we invested in was not using a top fund administrator, a big 3 or big 4 accounting firm and one of the top 3 law firms. Too expensive. But from the prime brokers they were using and the other vendors, they were able to provide enough institutional infrastructure to demonstrate that they're able to manage the investments as well as manage the business, right? Bob said it before, get help from your vendors because your interests and their interests are aligned. Because the more you grow and the bigger you become, quite frankly, the more profitable it is for them. So, they want you to be big. They want you to raise lots of money and become awesome. And I personally do like emerging managers because I love a good success story.
Thank you, Steve. Bob?
Yeah, I would say one of the biggest things to focus on is, you're running a business now, right? You're not working on a trade desk any longer. You're running a business, you own it. And ultimately what you have to do is sell your business, right? You got to be saleable. I think Steve said that word a few times earlier. And so either, you got to be able to do it, I think, to sell it. And I understand not everybody is entirely comfortable selling sometimes. Some guys would say, hey, I don't have that type of social personality, whatever. But, and you can, hire people. You can hire a marketer to sell your fund, but ultimately they're going to want to see the manager behind the curtain, right? And so you've got to be able to sell your fund. You got to be able to communicate the strategy. So really focus on, I think, really communicating well to the investment community, what your strategy is. And you actually are a salesperson right now, whether you believe it or not. You're selling your strategy, and the more exposure and practice you can get in that kind of in that space, do it. Anytime you get a chance to get on a panel such as today, for myself, Steve, and Lance, thank you, Mohammed. But you get an opportunity to talk about your fund and get some exposure, do it. That's the only advice I would give. If it goes poorly, you'll learn from it. If it goes well, you'll reap the rewards.
Yeah, it's a marathon, not a sprint. And follow up. I think, monthly distributions, sending stuff to investors like Steve, whether it's educational pieces, constantly being in front of investors. It's a sales process. Let's face it, and it's also having the proper expectations. We would love for everyone to call up Steve today, and then tomorrow they get a check for $2 million. That's not reality.
Right.
So
but it's not reality, and the check is in the mail. If anybody thinks that
right.
It is, right?
It's
Lance
not
will
reality.
Lance will handle all my mail in that particular case.
Right.
But also on the flip side, don't call me up and say, we've been sending you information about our fund for a year. When are you going to send me a check? Right? Like they're indignant that they actually had to tell me about themselves for so long. I go, because I do want to promise you this. For any investment that we look at, I promise that we are going to try your patience to the breaking point. And just when we think you may have a mental breakdown from waiting for us so long, we're going to have you wait some more because we operate slow, right? Like think molasses in wintertime slow. And I offer you that now as fair warning, right? Some of my peers, they're a lot faster. We, not so much.
It is a marathon. And I will give you this, not to scare anybody with a horror story. The longest pursuit I've ever heard was someone did get a check eventually, but it took 4 years. So I commend that person for their perseverance. I've never heard a courtship that long, 4 years, but it definitely, Lance is right. I would say institutionally, even, it could take 12, 18 months, 24 months. Yeah. Even when you get the verbal, it could take a year to get that money in the fund. So you got to be realistic about timing.
Yeah, 4 years is like a marriage, right? They're more than just that. That's like 4 years of dating, man.
Yeah.
Awesome. Thank you. Before we conclude, just want to thank you, my panelists. Thank you, Lance. Thank you, Steve. Thank you, Bob. It was a pleasure.
Any questions from anybody?
Let me see. No one sent anything.
Cool. Well, it's been a pleasure. Thank you so much.
Thank you.
Thank you, everyone.
Thanks, everyone. It's a
Appreciate
pleasure.
it.
Have a great
Thank you
weekend.
very
Thanks
much.
so much.
Yeah, be well.